Change is inevitable, and the disruption it causes often brings new opportunities. This statement perfectly suits to startups. They are young, innovative, idea-driven, and most importantly, they are disruptors. They totally redefined the conventions in every industry they entered, like retail, food, commuting, travel, education, etc. And now, it's time for finance. A group of new age Indian startups are sending shockwaves across the finance industry through their buy now, pay later business model, and they may soon be in competition with credit cards. So, what is buy now, pay later business model? Why is it gaining popularity? What are the positive and negative aspects of this business? We will answer all these questions in today's episode. So, watch this video till the end, and without any delay, let's get started. Let's first understand what is buy now pay later business model. For simplicity, we will call buy now pay later as Bnpl. If you've been doing online shopping, you must have come across Bnpl services. Flipkart and Amazon call it pay later service. Paytm calls it postpaid. Whatever the name may be, the logic is same. As a customer, you will be given a credit limit. Using this credit facility, you can buy the product you want and choose to pay for that product after some time, which typically ranges from 30 to 45 days. If you make your payment on time, there won't be any interest on your due. But if you fail to make the payment, then you will have to pay some additional charges. It is as simple as that. I know what you are thinking. It sounds very similar to credit cards, right? Not exactly. Let me explain why. Our societies are driven by consumption. More the people spend, more the companies make profit, and economy grows. The fate of all the companies is dependent on this one factor. To survive, they have to sell their product. They have to sell their product even when you don't need it, even when you don't have enough money to buy that product. Over the years, companies came up with various methods to induce you, and one such weapon is credit. Don't have the money? Take a loan and pay the amount in easy monthly installments. Again, loans are meant for some high value purchases like cars and homes, and they require lengthy paperwork which takes time for approval. What if you want instant money? What if you are in mid-month cash crunch or want to buy a smartphone? Credit cards can solve this issue, but they have a very low approval rate in India. As per Statista research, there are only 578,000 credit cards in India, which is only 4% of the Indian population. Again, many people own multiple credit cards. So roughly 96% of the Indian population don't own a credit card. The problem is not everyone qualifies for a credit card, and even if they do, not everyone applies. This is where a more flexible solution has emerged in the last few years, which is buy now pay later or Bnpl. Bnpls are small ticket loans which start from as low as 500 rupees and goes up to 60,000 rupees. Users can avail this facility on online as well as offline purchases, mostly via apps which function much like Paytm or PhonePe when it comes to making instant payments. Bnpl companies are mostly startups, and they are essentially serving the population who are in need of small credit and not covered by credit cards. For example, a student who is not eligible for credit card can still avail Bnpl services. Several startups such as LazyPay, Simple, Zest Money, ePay Later, Pine Labs, Capital Float and more are operating in this space. According to industry tracker Traction, there are 33 Bnpl focused startups in India, and these companies have essentially changed the way credit works. Another factor which differentiates Bnpl from credit cards is the interest rate. It's a well-known fact that credit cards are the most expensive form of credit. Interest rates on missed payments can go up to 48% per annum, whereas Bnpl companies charge around 0 to 24% interest rate or just a late fee depending on the merchant, tenure and the borrower. For example, a leading Bnpl startup Simple levies a charge of Rs 250 plus GST as a late penalty if you miss a payment, while most private banks impose 48% per annum charge on loans taken. But that creates another question: how do Bnpl companies make money? There are three main revenue sources for Bnpl companies. Their main source of income is merchant fee, which is the same way credit cards also make money. For every transaction, Bnpl companies charge a percentage as fee from the merchant who is selling the product. Merchants are ready to pay this fee because they are getting more sales because of this facility, and they are ready to let go some portion of their profit margin. You see, BNPL companies operate through their apps, and some apps also charge user fee to use their platform. I found that some American BNPL companies are using this model. For example, QuadPay, an American BNPL company, charges $1 as platform fee with every installment payment. But I'm not sure about the Indian companies. When users miss payment, they also subject to late fees and interest depending on the app. Users also pay interest on the installments. That brings some income for these companies. But what is driving the growth of BNPL companies? Why are they booming now? You see, the usage of credit cards is more prevalent in Tier 1 cities, and BNPL companies found a large user base in Tier 2 plus areas over the last 1 year, thanks in large part to COVID-19 pandemic, which changed the way consumers shop. Online shopping has seen a huge spike in last 18 months, mostly from the lower tier cities, as people used internet to order groceries, other essentials, clothes, utility items and more. On the flip side, layoffs, a tight employment market, salary cuts and suspension of increments has added to people's cost of living expenses, forcing them to consider credit options to relieve themselves from the financial pressure. All this resulted in a strong demand for the credit, and BNPL companies have been able to capture a lot of this market. LazyPay, for example, saw a huge surge in its overall customer base during the pandemic, while Simple witnessed a 40% increase in its daily transactions. As per Economic Times, the value of Indian BNPL transaction has grown to around $2 billion in less than 18 months from just few millions in 2019. Banks had the perfect opportunity to enter into this space because they have enough funds and have a good understanding of the lending business. But banks were in dilemma because if they enter into BNPL business, banks will be competing with themselves due to their existing credit card business. So, majority of the banks choose not to enter into this business. Instead, they enter into partnership with BNPL companies to provide credit. For example, ICICI Bank is offering pay later services in partnership with Pine Labs on its app, while Axis Bank owned Freecharge has also forayed into this space. Other companies also opted for these partnerships. Flipkart is facilitating their BNPL transactions through their subsidiary Flipkart Advance, while Amazon has partnered with non-banking financial company Capital Float. Paytm is offering BNPL as a part of postpaid services in tie-up with Aditya Birla Finance. In the edtech space, Byju and Unacademy have partnered with LazyPay and Capital Float. So the demand is largely coming from the three sectors, which are e-commerce, travel and edtech. The rise of BNPL companies is not specific to India. All over the world, BNPL companies are gaining popularity and reaching peak valuations. For instance, Klara, a Swedish BNPL company, is valued at $44 billion, which is almost equal to the valuation of Indian IT services company HCL Technologies. Indian BNPL companies have also seen their valuation go up in the last 1 year. So, is it the end of credit cards? We cannot surely say that credit cards will go out of existence, but BNPL companies will eat into the credit cards business. Experts even say that by 2024, BNPL business will control 9% of the lending market. You see, in the business of lending, most important factor is the rate of interest, and BNPL companies do have a stronghold in this area. Apart from that, convenience is another strong factor which is in favor of BNPL. You see, to use BNPL services, you don't have to use any card or enter any card details. Everything happens with just one click, and shoppers love convenience. In a study conducted by management consulting firm McKinsey on 2 American BNPL companies, it was found that of the consumers who took loans from these 2 companies, about 80% already had a credit card with enough credit available to fund the purchase. But still, these consumers opted for BNPL because it offers cheap credit and easier payment terms. That highlights the changing trends. So, is buy now pay later service really good, or is it too good to be true? Let's look at the advantages and disadvantages of BNPL services. We all know that credit card companies are charging very high interest rates, and at some point it has to change. The competition for credit market with the entry of BNPL companies can lead to lower interest rates and ultimately benefit the customers, just like it happened in telecom industry with the entry of Jio. Also, BNPL companies are targeting the population which was not served by credit cards. It is one more step towards the financial inclusion where underserved population can avail credit, which ultimately accelerates the economy. From retailers' point of view, they can increase their sales. Most of the merchants who are partnering with Bnpl companies are those offering low value goods but want to increase the sales and reach new customers. So it's a benefit for them. On top of everything, credit industry struggles with debt defaults. You see, Bnpl companies don't do a thorough credit check of the customers. They do something called a soft credit check, which increases the risk of defaults. While the default rates of Bnpl business in India is not in public domain, but some experts say the industry default rates have hovered between 15 to 20%. Given the low interest rate charged by Bnpl companies, it looks like high risk and low reward. There is another risk that these Bnpl companies are simply encouraging the customers to overspend or encouraging impulsive buying. For example, in US, these short-term loans, the category to which Bnpl belongs, saw 215% jump year-on-year in the first 2 months of 2021, according to the data from Adobe Analytics. Consumers using such services placed orders that are 18% larger compared to the same period in 2020. There's a possibility that same trend can be repeated in India. Because the Bnpl cost less and convenient, there is nothing that stops consumer from racking up balances with various Bnpl companies, and customer may find himself in a situation where large portion of his income is going towards EMIs, and sometimes it may lead to defaults. Well, there are positives and negatives, but it's a fact that we are witnessing a path-breaking change in the way credit works in India. And that's everything about buy now pay later business model. I hope this video is informative, and if you find this video helpful, hit a like and share it with your friends. Thanks for watching. See you in the next one.